The more we can interrogate those apples, the less likely we are to end up with one that's rotten on the inside. Hello everyone. After our last video, when we discussed the importance of research, Lachlan, one of our clients from Coffs Harbour, asked, is it even worthwhile going to all the effort? Why wouldn't someone just invest in an ETF? And to be fair, it's a great question, Lockie. And for a lot of people, you're right. Investing in an ETF might actually be their best option. The truth is, it's actually a more complicated question than many people may realize. But I think what most people mean when they talk about an ETF is a listed fund that mirrors the returns of the index. Now, there are actually many other kinds of ETFs, and that's probably a conversation for another time. But in essence, what you're buying is a fund that purchases all of the stocks in the ASX 200 in proportion to the weightings within that index. So for instance, 11% of your portfolio would be in Commonwealth Bank. 8% of your portfolio would be in BHP, etc., until you end up owning the appropriate portion of each of the 200 largest ASX listed companies. It's actually a great way to invest broadly in the Australian economy. It's easy. Any broker can buy or sell an ETF for you. It's cheap. Most ETFs will charge less than 0.25% in fees. It's passive, which means you don't need to make any real decisions. The algorithm will pick the stocks for you and rebalance your portfolio as necessary. It's diversified, like we said. You own 200 companies at various weightings with a single click of the button. And perhaps most importantly, it's generated really good returns over time. It's the perfect option, an ETF, for the investor who wants zero decision making. It's easy, and you'll reliably get what the market returns. But the question for us is, can you do better? Is there a way to generate better returns and at the same time reduce your risk? And I think we can. See, I think the challenge with an ETF is that by design, it buys all of the companies in the index, irrespective of the prospects of those individual companies, without regard for the intrinsic valuations. And that may be fine while markets are booming and economies are strong, where the rising tide lifts all boats. But the question that I often have is, what happens if one of those companies within the fund finds itself in trouble? And the problem for ETF investors is the answer is nothing. The ETF will continue to hold a company so long as it remains part of the index, irrespective of that company's prospects. Now, a managed fund like ours distinguishes ourselves from an index because we only hold positions that we like. We don't have to hold any particular stock just because it qualifies for an index. I guess if we don't love it, we just don't own it. And I suppose ultimately it comes down to the question of how much do you value research over algorithms or averages? Now, let me give you a simple example. When I go shopping in the supermarket for apples, I'll interrogate each individual apple until I find the ones that I really like. Now, I appreciate that some people might just grab whatever enclosed plastic 5-pack of apples that are nearest them, unassessed, and reconcile themselves with the idea that the supermarket is probably going to provide pretty good produce on average. And that's fine, but that's not how I pick fruit, and that's certainly not how we buy shares. Our view is the better we understand a business, the better we can understand what it's worth. And the more we can interrogate those apples, the less likely we are to end up with one that's rotten on the inside. And if by chance we discover that something is cheap, we can go and buy more of it. And if we discover that something is expensive, perhaps we can sell it. All right, so let's bring it back to equities. What have we done over the years to de-risk an investment and to get better returns? In mid-2021, we already had an established position in uranium when all of a sudden companies fell on the day by about 20%. Now, granted, at that point, our holdings were still up about 300-ish% from our original purchase price, but rumor had it that there was an accident in China. And I think for most investors, their decision at that point would be either to believe the worst of the rumors and sell immediately, getting a fairly good price, or to ignore the rumors and buy more at the now discounted price. We, though, took a different approach. Instead of guessing at the severity of the situation, what we did was we leveraged our networks to find someone in China who could safely access the area in question, and I emphasize the word safely. That person provided us with live feedback over the next fortnight, giving us daily readings of a Geiger counter and also arranging images of the street for us. And what we found was that doing this little extra bit of research gave us the confidence to not only hold on to our existing positions, but also to increase them. Confirming the facts gave us confidence, and understanding the situation reduced our real risks. And in the months that followed, many of our holdings in uranium doubled in value again. Understanding value reduces risk. On the other side of the same coin, understanding intrinsic value also provides the opportunity for outsized returns. For instance, a $100,000 investment made in our value fund at inception would have generated about 13 to 14% per annum, generating somewhere in the vicinity of about $341,000. The same investment at the same time in the ASX 200 would have generated around about $261,000. Still a pretty good result, but about $80,000 less, which translates to about 30%. So what are my two takeaways? Number one, we believe that research is the key to understanding the intrinsic value of a business, and it's the secret sauce that drives performance. I think number two, we also believe that understanding what you're buying doesn't just improve your prospects for returns, it also fundamentally de-risks your investments. And even that, just by itself, adds a heap of value. Lockie, you can do just fine by investing in an ETF. It'll give you diversified exposure to the Australian economy. But if you want to have a chat about this, or about topping up your investment with us in our value fund, you know I'm just a phone call away. Now, to everybody else, I hope that however you invest, that this discussion adds value for you. And I truly do wish you the very best of luck. Bye for now.